Welcome everyone to today's RaaS Research Group Stock Take webinar, where we will once again dive deep into the analysis of another promising ASX-listed stock. The team at RaaS Research have scoured the ASX for high-quality stocks and have done the work for you. And what they've done is they've brought these stocks to this webinar to enable them to give a deep dive and have a good look on your behalf into the stock that we will be focusing on today, and then let you hear from the company itself. So today we are focusing on on SunRice Group, ASX code SGLLV. The SunRice Group is a consumer-focused global food group comprising multiple businesses. SunRice was built by the Australian rice industry over many decades, and today is one of Australia's leading branded food exporters. RaaS Research Group's detailed analysis, presented by Senior Analyst John Burgess, will cover all the main themes, financial models, and potential pitfalls any scrupulous investor should consider before making a decision. So pay attention to what John is telling you. He's done the work, he's done the research, and he's just issued research, and he will give you the insight into SunRice Group. Following John's presentation, you'll hear from SunRice Group Chief Financial Officer, Dimitri Courtelis, who will provide a detailed presentation plus participate in Q&A. That's your opportunity to ask questions of John and Dimitri and get a greater understanding of the business. So during the presentations, get your questions ready. Submit them using the Q&A button at the bottom of the screen, and I'll put them to John and Dimitri during the Q&A session. Thanks for joining us, and without further ado, let's get started. Please join me in welcoming RaaS Research Group Senior Analyst John Burgess, who recently released detailed research on SunRice with the key insights to be shared with you now. John, thanks for your time.
Thanks, David. And we'll just go to the agenda slide. I thought we'd take a look through the key divisions of SunRice and their key drivers in terms of earnings outlook and the current state of play of those drivers. Have a look at industry M&A, which is very much right across the industry, not just rice, but agriculture. There's been a lot of M&A for a long sustained period of time, and SunRice is no different. So we'll have a look at some of the history there, look at the valuation, look at some of the peers, the valuation and the sensitivities, as David mentioned. If we go to the next slide. So if we start off, SunRice has two major divisions. So there's 5 divisions, but 2 large ones. The first one is the international rice trading, which is about roughly 40% of EBITDA. Is a little bit of a black box in some ways, but at the end of the day, it's got a very large exposure to the Pacific Islands, which is almost half FY24 revenue, and PNG in particular. And they've got sales into the US, Middle East, Asia, and obviously it's an avenue to clear Australian grown rice from the rice pool. So it's a very this business was born about and really grew from the volatility in Australian rice harvests over time and the need to source from elsewhere, and the division just got bigger and stronger in terms of its size. I thought it was important. We went back over the last 8 years to have a look at the EBITDA from this business, and over some very volatile periods, and this is true of obviously most agricultural companies, the business has delivered on average, has averaged 38 million in EBITDA over the last 8 years. In the last 2 years, it's been closer to 46 million. So this is in agribusiness terms, it's a relatively consistent earnings stream, and certainly the last 2 years have been much stronger than the last 8, and we'll get to the reasons why on the next slide. In terms of, I guess obviously we're talking about international rice trading. Rice itself is obviously a very large commodity globally. There's been pretty steady. There's year in, year out steady growth in the demand for rice across the globe. India is by far the largest exporter of rice, which is, I guess, where the international business plays in terms of sourcing, exportable rice and then finding a home for it. And then Thailand, Vietnam, Pakistan, the US are the next biggest markets in terms of exporters. And obviously within rice, there's a lot of different countries that produce rice, and there's a lot of varietals of rice, and that provides opportunities for SunRice in terms of sourcing. And because you've got different regions and different growing regions and different demand markets, there's very rarely a year where there's not a drought or an export ban or some planting of alternative crops that brings up sourcing opportunities for the business. So if we go to the next slide. We'll have a look at the current state of the international rice market. Very simplistically, I would say it's a much more complex market than this sort of chart indicates, but it gives you a pretty good feel for what's going on. We've seen, rice prices have sort of consistently moved higher over the last 10 years, but in the last 12 months, they've particularly had a bit of a spike because of an Indian ban on non-basmati rice, an export ban. And that pushed the prices up, and that can cause some issues, and particularly when you're dealing with sales into Pacific Islands in terms of being able to pass those prices through. But post that spike, prices were relatively stable and have been for 12 months, and those bans are now being lifted. And so the USDA is forecasting Indian exports to increase 20% in calendar year 25. And that'll obviously take the pressure off some of these rice prices and provide more opportunities to source rice. And as a result, the prices of most of these rices coming out of Thailand, Vietnam, Pakistan have dropped about 10 to 13% in the last 2 or 3 months since these bans have progressively been lifted. So I guess one of the opportunities is that for half of this business, the rice prices become a little bit more affordable for some of these Pacific Island countries, which is a mild positive for SunRice going into the next financial year. So international, I guess in summary, very large business within SunRice. Always opportunities emerging from different regions. Rice demand consistently grows, and actually the last 3 or 4 years, there is still there's been a reduction in the stocks of rice because of various droughts around the world. So a pretty positive position at the moment. We move to the next slide. The other big business, about 32% of EBITDA, our adjusted EBITDA is the corporate business. And this is really a business, I view it as an infrastructure business. They have storage and processing facilities. They receive income from their growers to process and store harvests. And they also receive income from other divisions for the use of key brands such as the SunRice brand. So the IP of that brand sits in the corporate business. Although it's quite a complex formula, I believe, simplistically, and we just try and look at simplistically, this business charges the fee for providing this infrastructure based on a cost of capital calculation. And the biggest variable within that cost of capital calculation is the 10-year bond yield. And so that bond yields, and we'll see in the next slide, that bond yields increased from the COVID lows in the last sort of 2 years and remains relatively high compared to the last certainly 5 or 6 years. And that's supporting this business and has supported this business over the last couple of years. I'd also note that the CapEx spend to maintain this infrastructure is relatively low compared to other peers. So CapEx to sales and depreciation, CapEx to depreciation CapEx to sales is very low considering the size of the asset base, if you like. If we go to the next slide. So as I said, the 10-year bond yield sort of back to around that 4.6%. And so that's supportive of the cost of capital charge and the return requirements from that infrastructure at current levels. There is a potential upgrade of some latent facilities, and in fact, in theory, whenever SunRice spends money and upgrades facilities, the cost of capital model almost ensures a return on that investment. Because it is the model used to charge the growers. The other key issue in this business is that the rice harvest and the volume of that harvest being enough to obviously utilise the storage and processing facilities, and also to cover the corporate costs that are allocated to the rice pool. And at the moment, as we sit, the harvest looks pretty adequate, and water storage levels are adequate for at least into FY27 on our estimates. So again, that for the next 2 or 3 years, we've got. In fact, SunRice is asking growers to reduce their plantings for this year to try and keep the balance in a sort of Goldilocks position. So again, with bond yields where they are, with the harvest levels covered, relatively covered out to 27, the corporate business, is in a pretty good position near term. And so that's two of the largest, or the two largest divisions within SunRice, being over around 72% of earnings, look pretty stable over the next couple of years. As we go to the next slide. The other 3 businesses combined represent the rest of the business. We have CopRice, which is started out as just CopRice, but it's seen some acquisitions in equine food, and so it's really a combined animal feed business. And in fact, most interestingly, GrainCorp's moving into this space, so it is an area for commodity processors to go into, to use some of the offcuts and and I should say Ridley also has gone into the same area. So and that business is the acquisition of Easy Feeds a couple of years ago has been very positive for the group, and the CopRice, the sort of legacy business, has been turned around over the last 12 to 18 months as well. But that's about 13% of EBIT. Rice Foods, which is really more of what you see on the shelves in terms of microwave rice and packet rice, is 10% of earnings. And Riviana, which is predominantly an imported branded food business. Most of the imports come from Europe, and that's about 6% of earnings, and has been impacted by high freight costs, currency, availability of some of these products as well, and private label competition. So all those businesses have that there are some moving parts in terms of demand and supply, but certainly CopRice has been the standout of those 2 businesses over the last couple of years. So we go to the next slide. As I mentioned, M&A is a big factor in this industry, well, broadly agribusiness. Some of the peers that we use to value SunRice include Bega, Elders, GrainCorp, Ridley, and you'll see over the last 2 or 3 years, they've all made substantial acquisitions. These are the larger ones. There's been a couple of bolt-ons as well, and it's a function of the industry and these big players getting bigger, and I think getting a bit more diverse to try and offset some of those seasonal impacts of the once core businesses. And Bega is a good example of that. Elders only yesterday, I think, announced the $475 million acquisition, and interestingly, they all seem to happen in November and December. But SunRice is no different. SunRice has been steadily acquiring and increasing the size of those acquisitions over the last 2 or 3 years. Save a Life recently in July, Pride's Easy Feed, as I say, which is the equine, back in December 21, and KJ and Brands. So we would expect, obviously, and I think SunRice's medium-term targets in terms of their sales and EBITDA, in some ways is going to have some M&A in there to supplement that growth, and it's very consistent. That's very consistent across the broader agribusiness space. So watch out for that as we go to the next slide. Just looking at those peers, I thought it was really useful to highlight the CAGR EPS growth of SunRice and its peers over the last 4 years. So as I said, domestically, we use Bega, GrainCorp, Elders, Ridley as the key peers. And internationally, a company called Ebro Foods, which is based out of Spain and very much a rice. It's about 85% rice, 15% pasta. Is the closest international peer. Excuse me. And over the last 4 years, you'll see SunRice sits number 3 in terms of the peer group of CAGR EPS growth. And also, very interestingly, it hasn't had a down year in those 4 years. You'll see some of the volatility in the other players, GrainCorp, Elders, Bega. They've all had substantial down years in 1 or 2 of the last 4 years, and that's a testament, I think, to the growing diversity of SunRice, of the core rice business and the sort of underlying and its global nature, and obviously the corporate business and the ability to extract value from that infrastructure. And so that as I say, I think gives you a feel for SunRice's proposition relative to some of the peers, and in terms of earnings consistency and visibility. If we go to the next slide. And so when we look at valuing SunRice, as we went through those divisions quickly, we use a sum of the parts valuation, and multiple based, because we view SunRice as a mixture of infrastructure, as I mentioned with corporate, as fast-moving consumer goods, which is sort of Riviana rice food, that's very much an FMCG style business, animal and pet care, which is another very different style of business, and that's their CopRice business, and very similar, well, not similar, but certainly Ridley is a very good peer, being predominantly an animal pet feeds business. And then international trading, which is it's a substantial international business, and a very different business to the more sort of asset intensive infrastructure businesses. So again, warrants a different multiple or a different approach in our view. So we look at FY25 consensus earnings. We subtract the rent, the ROU or the rent, cash rent out of that EBITDA to get an adjusted EBITDA number, and apply the appropriate multiple compared to, depending on the business we've selected. And we come up with a valuation of our latest valuation, which was in our note, I think, about a month ago, was 12.32. We do obviously review this from time to time. At the moment, we're getting quite a few updates, guidance updates and results for the likes of Elders and GrainCorp, and we will let the share prices and the consensus estimates settle down, and we will review this valuation post the result, which is due in December for SunRice. We don't apply a discount for the share structure of SunRice, which is like an A and B class structure. We don't apply a discount for any sort of size issues. We have tried to select these businesses on appropriate size. We haven't used Treasury, for example, as a peer, because we feel it's a larger business, much larger business, and therefore less appropriate to apply to SunRice. So we've stuck to the businesses in the 300 to 2 billion sort of market cap range. But at current levels, that's about a 30% increase or 30% upside. Stocks performed very well over the last 12 months. We still obviously, our valuation still implies upside, and we will revisit that in December. As we go to the next slide. In terms of sensitivities around both, I guess, earnings and our valuation, obviously, adequate rice harvests are key to utilise the infrastructure and to cover the corporate overheads of the rice pool. And as we say at the moment, that looks relatively low risk for the next 3 years. Working capital is, and if you've got too much harvest, you can have you'll end up with a lot of working capital, and that obviously draws down cash and increases debt. That can change the metrics a little bit. Obviously, the 10-year bond yield is a key driver to corporate earnings. And rice prices globally. I think for most commodities, most commodity traders, stable rice prices or gradually rising, gradually falling prices is sort of an ideal scenario, and that's sort of what we've got at the moment. In terms of obviously when you value stocks, I mean, as I said, we don't discount the business for its class structure, but some people may. So that is up on an individual view how you view that, and obviously from a valuation point of view, when we look at the peer multiples, obviously if we have a peer multiple sum of the parts valuation, then the multiples of those peers can obviously change our valuation without necessarily changing what SunRice is doing. So it's always a risk. But at the moment, the market continues to go higher and multiples continue to go higher. So it doesn't seem to be a risk at present. Just as a final comment, it does feel that the market wants to believe in a lot of these agribusiness stories. Bega is a good example. The roll-ups, they've had their issues, but the stocks continue to sort of, even after an issue, continues to run higher. I think there's a real want to be invested in this sector over the medium term, which is a good thing for SunRice as well. So, David, that's hopefully a very quick, simplistic run through of the business and where we sit on our views in terms of valuation.
Thanks, John, for that detailed analysis. And remember, a copy of the recently released research on SunRice Group can be found on the RaaS Research Group website. Now it's time to hear directly from SunRice's Group Chief Financial Officer, Dimitri Courtelis. Please join me in welcoming Dimitri, who will run through the presentation and then, as I said, be available at the completion to answer any questions you may have. So get your questions ready. Dimitri, over to you.
Thanks, David, and thanks, John, for that helpful intro into the business. So what I'd like to do is take you all through a bit of a presentation we've put together. These slides are compiled from our FY24 Investor Preso, which we released in June this year, and our AGM, which we held in September. We're currently in blackout for our half year because our SunRice year end is actually 30th of April. So 30th of October being our half year, and therefore can't really talk to anything outlook related. So I'll refer you all to AGM insights for that. But in a month's time to the date, we will be releasing our half-year results, and obviously we'll provide further guidance to the market as required. So with no further ado, what I'd like to do is just take you through some of the updates that I've got for you today. You'll see an important disclaimer on the next page, which just talks to our A and B class structure. Don't expect you to be able to read this on screen, so you will be able to find this in our AGM material as well as on the investor website in SunRice. Next page, please, is essentially the structure of our company, where we deliver for both A and B class shareholders. It's a complementary nature of both A's and B's. A's are represented by your rice growers, and that is a voting share, and B's are listed on the ASX. It's a non-voting share in most cases, but the B's are fully entitled to dividends and essentially own the whole balance sheet. So whenever we talk about the company from an investor perspective, it's the B class shares that are represented, and the brands, the assets, as I mentioned, dividends, 100% of the business and balance sheet, etc., is essentially owned and represented by the B's. Now, there's three major components where the B's actually benefit from the A's. First is an asset finance charge. So that was what John was referring to in the corporate segment. Because the B's own all of the assets in the business, and the A's, being the rice growers, essentially rent those assets from the B's, we charge the A's a rental charge, or it's an annuity style income for using those assets, and that shows up in the corporate segment. Then we also have a brand charge, because once again, the B's own all of the assets, including all of the brands and the IP. And as we market the rice around the world grown by our rice growers in Australia, that attracts a brand charge, which shows up as an income in the corporate segment. And then thirdly is essentially the absorption of overheads. As the wider system is in equilibrium, and what I mean by that is when you have a relatively healthy Australian crop, 500,000 tonnes is our Goldilocks number that we keep referring to. That helps mop up a whole bunch of overheads around the group as that gets apportioned between all of our divisions. So those or that setup is essentially what we've had in existence, and we corporatized this business in 2005. So whilst it does have a heritage coming from an agri-focus co-op days, we listed the business on the NSX in 2007 and then listed on the ASX in 2019. So for the past 17 years, we have navigated this A and B class structure in a listed environment, and that perceived conflict of interest has been very well managed from a governance and a compliance perspective. And you see that in the results. We don't rob Peter to pay Paul. You don't disadvantage one class for the other. Both are managed very, very strictly within our governance protocol. So that should give the market a bit of comfort. And when you look at our previous delivery over the last, call it 5 to 10 years, we've demonstrated that shift from agri into that global FMCG player is the focus of the business, and looking to reward shareholders with that very healthy divvy that we've been able to declare over the period, which I'll talk to in a few slides' time. The next slide talks about our branded products. So as I mentioned, the main focus is now, and has been for the last 5 years or so, shifting this business into a global FMCG player. Whilst we have the heritage in the agricultural side of rice growing, it's now all around global FMCG plays, and therefore more accretive earnings, your smaller bag products that we are able to put on shelves around the world, as well as the retailers in Australia. And I'm sure you'll recognize a number of these products. So when you look at some of these products, Australian rice, that's obviously rice that we grow in Australia, but also import from our international segment like jasmine rice and put that on shelves in Australia. Bottom left, you've got SunRice snacks. So that's essentially your rice chips, your rice cakes, your mini bites that should show up in kids' lunchboxes. They are healthier snacking, no gluten, or gluten-free rather, and of course low GI and healthier snacking for you. And then of course convenience food products that are products such as microwave rice, which form in a cup or in a pouch, and also help that ready-to-eat meal occasion that we look to target with consumers. So in our portfolio, you can go to the next page and some more products on shelf. There are over 1,500 products in our wider business. We operate in about 50 countries around the world, and again, 35 major brands in the wider portfolio. So top left, you'll see some rice products that are in our international rice segments. The Middle East is one of our major markets. We sell over 200,000 tons of rice, finished product rice, on an annual basis. That's one of our key markets where we export rice out of Australia. And we also import rice into the Middle East from our international supply chain as well. And John also talked about the Pacific. We essentially feed the Pacific. And this is across countries like PNG, Solomon Islands, the Fijis, Vanuatus of the world, right throughout the Pacific. And historically, a lot of that rice was exported out of Australia. But with the challenges in those regions over the last decade or so, and affordability issues of not being able to afford Australian rice, we look to position our Aussie rice into our more higher returning markets like the Middle East, Asia, the US, and in some cases, some of the countries in Europe. But instead of losing out on all of those other markets that we previously serviced, we backfill all of that opportunity out of our international supply chain, which I'll talk to. So we have essentially a business in Singapore where we source rice out of on any given year, 10 to 12 different countries around the world, and ultimately find the type of rice that we need to meet the consumer demands in the segments that we need to fulfill. Top right, we've got animal and pet food, which is represented by our CopRice segment. And again, we've moved away from what historical was a pure ruminant type of business. So we would use the byproducts coming out of the rice mills and put that into stock feed. We've evolved that business into more of a animal nutrition and pet food and pet snacking business. And that's evident with the recent acquisitions like Pride's Easy Feeds, which is for your equine segment. So that's horse racing, but also for trainers and those that have horses on farm and keep them all as pets. And then, of course, in the pet space with Save a Life, our most recent acquisition, which is the dog food products that are listed in Petbarn. And you'll notice with pretty much coming through COVID and out of COVID, this huge demand for pets, and we call the term the industry is calling the term the humanization of pets. And I'm sure many of you at home have little pets that have names that are no longer, the likes of Rover. It's more now names that you probably call or kids. We have an Archie at home, to give you an example. So with that, we're able to really ride that consumer trend of providing products into that pet food segment, which is one of the fastest growing segments in consumer land at the moment. Bottom left, represented by our Riviana segment, is your gourmet and entertainment platter style offering. We import products from throughout the world, predominantly in Europe and out of Asia. So, for example, we have waffles coming out of the likes of Brussels. We've got croissants coming out of France. We import olives coming out of Spain, Italy, Greece, and the likes of pesto pasta and other types of dips and sauces, some of which we manufacture in Australia. This business historically was a 100% net importer, and with some local acquisitions, we've evened that out somewhat to more of a 75 to 80% importer to help offset some of those importing challenges like FX and shipping and supply overseas. And then, of course, within food ingredients, we offer a lot of products into the food service sector, and that ends up in hotel chains, in restaurants, cafes, and the like. So when you consider our footprint internationally, which you'll see on the next slide, you'll see that over 60% of our group revenue is actually generated out of Australia. We've got a split here of what's branded and unbranded, and over 70% is branded. So you can really start to see that shift of what historically was just a net exporter of marketing the Australian crop into now more of a global FMCG player, where we have the strength of our brands in these markets, that we have provided products for absolute decades, working with distributors and our customer relationships in all of these countries. And it really is spread throughout the world. So to John's point around the complexity and navigating the challenges, never mind just in the northern and the southern hemisphere, we literally are dealing with size of crops in different countries, whether that's in Asia, in Australia, in Sun Foods in California, which is one of our subsidiaries where we own a vertically integrated position that services the California market. And then we're looking to set up trials in South America, because you'll note from a degree of latitude perspective, South America and Australia, certainly the Riverina section where we grow rice in Australia, is similar in nature. So we're looking to pilot trials of growing the same types of rice. So essentially, we've got all four corners of the globe covered in terms of where we source rice from. And then, of course, we have the markets where we sell the rice into, and predominantly all under branded play. We do participate in government tenders from time to time, and that's what makes up part of the 27% in non-branded trades. But that's not where the future of the business will lie. We really want to accelerate this growth into branded products and ultimately, fully fulfill that global FMCG player of brands behind every type of product that we take to market. Next page gives you a bit of insight of our FY24 results. We did have a record year on a number of accounts. We had the highest group revenue on record of 1.88 billion. SunRice has a 74-year history, so we're pretty proud of that top-line delivery over that period, and equally delivering a fully franked dividend of 60 cents per share. That did comprise a special divvy, an interim divvy, and a final divvy. We introduced an interim divvy 2 or 3 years ago now, and the point was really around reiterating the consistency of earnings. We don't consider ourselves exposed to the pure agri play like some of our peers, which is also why you'll notice that even during Australian droughts, our earnings and our income might be impacted, but we have not dipped into loss. And over the course of the last 17 years in a listed environment, we've essentially declared and paid a fully franked divvy every single year. So hopefully give you a little bit of insights into how we're shifting this business, and consistency of earnings is absolutely key. Group EBITDA coming in just shy of 144 million, and that was 23% up on the prior period, and NPAT of 68 million, which also was 24% up on the year before. EPS just shy of $1 per share, and I've got some slides coming up further on around the trajectory of our EPS, and we'll just demonstrate the resilience of the business model. Now, the dividend yield of 9.2%, that was at the share price back in April of $6.50. Certainly pleasing to see how our share prices reacted to the results, and obviously the appetite of investors over the course of the last 6 months or so. But we have had a number of positive news that we put to market in terms of our results for FY24, our outlook to FY25 that we mentioned at the time. We also had the acquisition of SaverLife, and then of course the macroeconomic environment that we're in at the moment. So gradually, as the messaging gets out there more and more, I think investors are really starting to digest whilst on the surface a complex business, but consistent earnings and delivering that recognition and dividend back to investors for the journey. On the next slide, sustainability is an absolutely critical element and area of the business, and we really focus on this to create value for all of our stakeholders, whether that's our growers, our employees, our customers, and of course our shareholders. A number of highlights that we've achieved during the course of the year, so I'll just touch on a few of them. Firstly, our commitment to our net zero target of in 2050, and on track to deliver that, and working very hard in the background on all of the game plans and deliverables required. We also, in collaboration with the Deakin University, developing on-farm trials for various improvements in irrigation techniques. So that's reducing methane gases and also minimizing the amount of water used. So therefore driving the water efficiency and helping our growers with on-farm profitability, but equally reducing our emissions and ultimately our scope 1, 2, and 3 targets. We've also worked with our growers to transition from aerial sowing of seed to drill sowing of seed. That is easier on the environment, and it also uses significantly less water to do so. So again, Hello, am I back on? I'll just keep going. Okay, so some other areas, we submitted our emissions reduction targets to the Science Based Target Initiative, and again, following that net zero game plan that we have in place. And our emissions reduction targets across scope 3 flag, so that's forestry, land, agriculture. Those targets, SunRice was one of the first in Australia from a company perspective to submit those flag targets to the initiative. So again, demonstrating, but this is not just new news, this is the way we've operated and delivered for this business over the last few decades, and making sure that we're taking those farming practices wherever we grow rice around the world, whether that's in Vietnam or in America, or along the supply chain where we're sourcing from other growers, and making sure that we've got those on-farm growing techniques leveraged throughout the system, so that others are able to benefit from that as well. On the next slide, just highlighting where and how we basically delivered our improved revenue and profitability. So it was really off the back of both volume and value growth in our revenue segment. 70%, as I mentioned before, of the group's revenue is in branded sales, so should help demonstrate the consistency of earnings. And whilst there might be some challenges or noise on the supply side in terms of where we source rice from, depending on what's happening around the world, all of that rice is essentially destined into branded products that end up on shelves in supermarkets around the world. So we have the demand, and that's consistent in market, and it's a case of meeting that demand with the supply in terms of where we source and grow rice from, and of course growing that demand. So it's the depth in existing countries in terms of where we already have a footprint, but then also looking at new market entry and expanding that portfolio offering of where we take products to market. On the profit side of the business, essentially operational and efficiency in our manufacturing positions have helped drive profitability as well. We have a very extensive supply chain network, so looking to source, as I mentioned, rice from different parts of the world at prices that make sense for where we want to fill the demand. FY24 was indeed impacted by consumers, discretionary shoppers, cutting back on discretionary spending. So we've had to take that into account and come up with lower price offerings, and of course private label incursion in a number of the segments that we go head to head with. So that's been a challenge noticeable in Riviana Foods, our subsidiary in particular. And then of course from a dollar perspective, the US dollar strength has put some pressure on our imports as we've financed those through our Aussie dollar syndicates or banking syndications, and that's put a bit of pressure on the P&L as obviously all of those products denominated in US dollars have become more expensive. The next slide is a snapshot of each of our segments that form part of the group. So I'll just touch on each of them very briefly. Firstly, far left, the Australian rice pool, which is represented by Australian growers. So essentially that has a zero profit result because the profit earned in that segment is returned to the growers via a paddy price. However, some of the significant expenses in that segment show up as an income in the corporate segment, and that's the asset finance charge and the brand charge that I mentioned previously. So the segment delivered a revenue of 385 million, and that was up 15% on the prior period. With revenue growing, obviously pleasing, putting those products into new segments and fulfilling rice on shelf. But we did have some disruptions with the Red Sea shipping challenges, very expensive. When at one stage we weren't even able to put ships through the Red Sea and had to reroute that around Africa. So exporting out of Australia, getting to Europe or the other side of the Middle East, obviously very, very long way to go. And that's now begun to subside, but we obviously watch that position very, very closely with the challenges in the region. International segment, that grew with 22% top line revenue to 893. And predominant growth was underwritten by our growth in the Middle East, which is a big market, as I mentioned. So despite the challenges, rice consumption there remains very high, and we expect that to be the case going forward. Long grain pricing was a challenge, and John did mention the Indian ban on non-basmati. Now, whilst that ban has lifted in the recent month or so, prices gradually started to come off, so it remains a bit of a watch and brief to see how that settles and works its way throughout the market. Rice food, so that's the snacking portfolio that I talked to. Revenue was up as well, 7% to 121 million. Big focus here is into new product development and taking those exciting new products to shelf. And with those opportunities, revisiting some sales price strategies to help absorb the inflationary pressures, both on the cost side, but also with what consumers are feeling when you look at the basket of goods that they put in their shopping antics. And next one being Riviana Foods. So that achieved a record revenue in FY24 of just under 222 million, up on prior period. Improved metrics at EBITDA and bottom line. And again, those challenges really being the Red Sea challenges as we imported products out of Europe to get to Australia. The FX impacts because we source these products in euros and in US dollars. And of course, the cost of products like getting grain and corn out of Europe with Ukraine and Russia being a bit of a challenge into that supply as well. CopRice, as John mentioned, one of our exciting subsidiaries in terms of delivery over the last 2 to 3 years has really been a turnaround story of the base business and complemented by the M&A activity with the acquisitions of Pride's Easy Feeds in equine and of course Save a Life in the pet food segment, particularly dog food. So we look to grow that from strength to strength, and pleasingly those results are starting to speak for themselves in that segment. And finally, the corporate segment, essentially higher asset and brand charges that were charged to the rice pool segment, and that coming through the mix in that EBITDA of 48 million. Now, the weighted average cost of capital that we use in the corporate segment is essentially just to demonstrate to the market we do have a risk-based value included in there, because whilst we're exposed to the Australian rice industry, we make sure that the corporate side is earning their fair share of that income from those assets. So if there is a blip in the system with a drought in Australia, for example, the other years certainly do earn their fair share from a risk premium. And that's been generally between 8 and 10% on a WACC basis that is applied to underpin the AFC. So it does get its fair share of return and creating value for the group and ultimately for shareholders. A couple of pages coming in terms of metrics and trajectory. So the next slide, please, will show you just the solid track record of performance over the last few years from FY17 to 24. We've really been able to maintain and build that performance over time, even in years of low Riverina rice production. So if you look at FY20 and FY21, we had two of the smallest crops on record out of 100 years in Australia. And even in those years, we were still able to meet our global demand by backfilling all of that from our strategic supply sources and supply chains around the world. So again, just to demonstrate the resilience of the business model in terms of how we are able to obtain product to make sure we meet the demand. Top right, consistency of dividends coming through the mix. So regardless of what the weather has thrown at us in Australia or around the world, we've really focused to deliver for our B-class shareholders. And this should also give some comfort around, whilst we have an A and B class structure, the Bs are certainly rewarded for their patience and position in the business. Very healthy divvy and divvy yield over that period. And again, consistency should hopefully come through from a messaging perspective. And since 2017, we've invested over $300 million in acquisitive assets and accretive assets and M&A activity in the business. That's a split between about 115 million in M&A and 194 million in CapEx across our network. So again, we continue to actively pursue opportunities as they arise, but that's obviously value accretive opportunities, and just being patient through the cycle, whether that's in ANZ or international, and really to talk to our 2030 game plan. Inorganic growth will be required to supplement our organic growth plans as well. The next slide just talks to the EBITDA progression of FY23 to 24. So we did have a record year and delivered 144 million, up from 117 in the prior period. So again, shows that step change in improvement in the quality of profits, and international segments really being the key driver in there, as well as complemented by CopRice. Again, increase in return on capital employed up to 12.7%. So making sure that obviously we're returning on all of that employed capital in the business, and the asset finance charge is one of the key areas of that, demonstrating that the rice pool is paying their fair share into that corporate segment, which ultimately returns to the B-class investor. Almost there. So the next slide talks to our 2030 strategy, which is really focused on establishing that global presence and the vertically integrated business model that we currently have in place, that really look to extend in a number of jurisdictions that we either currently operate, so going more deeper, as well as expansive strategies into new markets as well. The priorities are really focused on a secure and a long-term viable Australian rice industry, and making sure there's a contained amount of crop that we use for working through the utilization of the milling operations in Australia, and export that product and also use it domestically, which shows up in the retailers like Coles, Woolies, and in the independents with Metcash as well. Aspirations to double the ANZ markets, aspirations to double the Middle East market, and also to develop our position more further in the US. We have a subsidiary there called SunFoods, and we're looking to expand that presence throughout the Western Seaboard in the US and certainly across the US as well. Building the snacking portfolio is also key, as consumers continue to look for those healthier trends of snacking, and convenience plays a big part in that. And then, of course, enhancing our subsidiaries like Riviana and CopRice. So again, aspirational target, but certainly it's nice to have something from a line in the sand perspective that we want to work towards, and we'll obviously keep the market updated on progress as we go through that journey. So that's the preso that I have for you today. I welcome any questions, but back to you, David. Thank you.
Thanks, Dimitri. An insightful presentation, and clearly the business has achieved a great deal in recent times, built off a very, very strong foundation that has been established, as mentioned, over many, many years. So first of all, congratulations on that. Now let's move on to the live Q&A session. As a reminder, you can submit your questions using the Q&A function on your screen, and I will be putting these questions directly to John and Dimitri. So a number of questions have come through. First one for you, Dimitri. You're looking at a repeatable result in full year 25 to the very strong result in full year 24. Can you take us through the key headwinds and tailwinds for the business as we sit here today?
Sure. So essentially continuing that branded growth as we put those products to market that I've repeatedly spoken about, and the opportunity around fulfilling that demand in market is something we look to replicate as a business, and that's both locally and internationally as well. Again, that's from a tailwind perspective, but then from a headwind perspective, we're still dealing with these challenges on the shipping side, the supply side. You have the FX playing a bit of noise in the background, and then of course the disruption and volatility in certain regions and markets around the world. But since we operate in over 50 markets around the world, you're never going to get that scenario where all 50 are firing on all cylinders. So it's just managing those dynamics and that volatility in terms of where we're able to source rice and fulfill that demand. So again, consistently playing out the and what we said in the outlook back in June was essentially a copy and a paste of what we delivered last year to the current year. So essentially giving a bit of shape around that.
The other one, which not unsurprising to be honest, is around dividends. So strong dividend in full year 24. The board probably hasn't met and determined this yet, but do you have an idea on the quantum of ordinary dividend, and is it repeatable based on the guidance you've given for full year 25?
Sure, good question, and I get this one quite often. So certainly can't comment on the quantum of the divvy, but the board absolutely turns their mind to managing the payout ratios, the quantum of dividend, and the consistency of dividends as well. So I would refer the reader to the track record, and hopefully that gives a bit of insight into what may or may not play out in the coming period. But certainly from a deliverability perspective, it's one of the aspects in the business that is top of mind at the board, and pleasingly we've set that record at 60 cents last year.
Now, as mentioned, and John touched on as well, debt reduction has clearly been a focus, and you've essentially paid down all your debt. What's the capital management priorities moving forward into full year 25?
So we do split our debt between our core debt and seasonal facilities. Core debt is used for M&A activity, strategic capex, and anything material in nature, whilst our seasonal debt is essentially funding our net working capital. So whilst the net debt is predominantly driven by seasonal debt at the moment, or the net working capital driven by seasonal debt at the moment, that's essentially a back-to-back against all the inventory that we have in the system. So if you do see the seasonal debt spike, it's not a bad thing. It just means we have that inventory in the wider system, whether that's in our storage networks, on water, or in market, and sufficient to actually service the requirements and the demand of our markets as well. So again, we'll continue with that strategy and make sure that the gearing levels and the leverage levels are in line with our capital management policy, which is absolutely the case.
And John touched on a point during his presentation that when you do spend money, you put it to work, and generally it returns very, very quickly. In terms of the Leeton plant, what's the spend you're planning to do there, and what returns are you expecting from this spend?
So there's a $20 million upgrade in our packing hall. So that's essentially going to improve the operational efficiency within the Australian rice utilisation footprint or platform. And that's ultimately, from a return perspective, will underwrite the assets in terms of the asset finance charge. So that is where you'll see that return come back through the business in the corporate segment. But you'll also get an upside benefit in the the paddy side of the business, because we'll be able to get a bit more throughput in the mills and benefit the actual paddy price indirectly for the growers. So it does benefit both sides of the business, but a lot of work goes into the business cases to make sure that our internal hurdles and returns are met, and which is why we don't rush to market with buying things. We have been accused of having a lazy balance sheet, but that's okay, because when we do spend the money, we make sure that it is accretive and it's put to work, so we are able to get that return.
There is a question here in relation to balance sheet and acquisitions. As you say, prefer to have a lazy balance sheet than rush into something that doesn't make sense. What does a perfect acquisition look like for SunRice?
Perfect acquisition. Well, we have demonstrated that we've spent 115 million on one of the previous slides that I went through on M&A in the last probably 5-year period. A perfect acquisition, we're certainly looking, and we've on record saying this before, a lot of that's been spent in Australia. So as we grow our international business, looking to complement how we take product to market, whether it's a brand or another position internationally, to help complement and supplement our group and really help accelerate our 2030 plan. So that perfect acquisition, probably more on the branded side of things. And we're certainly scouring the globe for those types of opportunities. It does have its own complexity as you're doing due diligence on international companies or brands and positions in a number of jurisdictions. But these are the types of areas that we're looking into to help access a lot of growth and unlock that growth and become a catalyst for the group.
Question here in relation to the cessation of the New South Wales vesting arrangements in July 2025 appears to have been taken positively by SunRice. Can you talk us through the reasons why that's occurred?
Yes, so that was the sole and exclusive export license that we previously have held. And essentially with that coming to an end, it does free up a bit of complexity on the regulatory side of things, because at the moment we are and were the buyer of last resort. So whatever rice was grown in Australia or within our growing network, we were obliged to buy that rice on behalf of growers and market that both domestically and internationally. Now, without the vesting arrangements in place, we're able to work more directly with some of our growers and come up more strategically with the type of growers and partner with the growers in a way that actually suits the business and, of course, suits the growers in terms of a more consistent type of crop, being able to plan a bit better, because at the moment, regardless of the size of the crop that's grown, we have to take all of it. So a bit of operational efficiency improvements we are thinking about on the cards. And again, just working a lot closer with the growers to potentially have multi-year contracts, because at the moment we only offer them 1 year out. These are the type of development opportunities that we're currently working on, and that vesting arrangement will end in June or July FY25 or next year. So working hard to make sure that we have that in place for when investing ends.
John, question for you, final question. Where do you think you've been conservative? I know naturally you are a conservative person, but hearing Dimitri's presentation and his positivity for where the business is going to go going forward, where do you think you've been potentially a little over-conservative?
Well, we haven't forecast any acquisitions, so I guess that's one thing. You could forecast acquisitions, which we haven't done. I think probably the recovery of some of the Rivianas of the world, which is there are still obviously legitimate reasons for being conservative relative to historic earnings because of the headwinds and FX and so on. But the earnings of those businesses are quite a bit below where they have been 2 or 3 years ago. So a fairly modest recovery in the near term. That's probably, and then international, I guess, I guess we haven't got our head around what the return of Indian rice means in terms of good or bad, how the magnitude of that. So we haven't got a lot of growth in international, outside of, modest growth outside of sort of the rice market rate of growth in the next couple of years. So they're probably the 3 areas.
Well, I'm not going to speak on behalf of Dimitri, but I think he would probably say, as would all SunRice Group shareholders. We'd rather be conservative and beat those expectations than the opposite. So, John, thank you for the detailed research and overview that you've presented today. And Dimitri, thank you for providing such a positive and compelling overview of the SunRice business, not just where it's come from, but where it's expected to go. So thank you both for your time today.
Thank you.
Pleasure.
And I'd also like to thank each of you for your participation in the webinar and engaging in the Q&A. We hope you found this webinar informative and valuable, and we look forward to seeing you at our future events, where we'll once again dive deep into the analysis of another